Markets have gone Australian interest rate mad. Hello everybody, I'm Leith Van Onselen, the unconventional economist, coming at you again with another macro breakdown, where today I want to talk about why markets have gone completely crazy on Australian interest rates. A few weeks ago, markets were tipping that the Reserve Bank of Australia would lift interest rates by 2.15% by the middle of 2023. Well, guess what? Markets are even more bullish, tipping the RBA is going to hike rates by 2.25% by mid-2023. Yes, that's right, folks. Markets are now even more aggressive on interest rate rises. As shown in the chart above by the yellow line, this would represent the fastest and largest series of rate rises anywhere in the developed world, beating out the US Federal Reserve, the Bank of England, the European Central Bank, the Bank of Japan, and the Reserve Bank of New Zealand. Now, just to put those rate rises in perspective, the 2.25% increase in interest rates would see mortgage repayments rise on average by 30%. This is shown in the chart on the left. Monthly mortgage repayments in the median price Australian dwelling would rise by $781. And in the more expensive markets of Sydney and Melbourne, monthly mortgage repayments would rise even more quickly, by about $1,200 per month in Sydney and around $860 per month in Melbourne. Such a sharp increase in interest rates would also see the ratio of debt repayments, both principal and interest, to Australian household disposable income rise aggressively. As shown in the chart on the right, Australia's debt servicing ratio would lift to near record levels not seen since the global financial crisis hit in 2008. Now, I'm not the only one that thinks that the financial markets are completely crazy on Australian interest rates. Australia's biggest bank, the Commonwealth Bank of Australia, also thinks the markets are dead wrong. CBA's head of Australian economics, Gareth Aird, said that if the cash rate rises to around 2.5%, as the markets are predicting, then mortgage repayments would rise to near record highs. This is shown by the top blue triangle in the chart above. Doing so, according to Gareth Aird, would tank the housing market and tank the Australian economy. CBA instead tips 1.25% of rate rises, which would take repayments to around average levels, according to CBA. This is shown by the middle blue triangle in the chart above. So what's the key takeaway here? The key takeaway is that markets are completely wrong on Australian interest rates. Such massive and fast interest rate rises would crash the Australian economy and would crash the Australian housing market. The good thing is that the lever is in the hands of the Reserve Bank of Australia, not the markets, and it is very unlikely that the Reserve Bank of Australia is going to lift rates nearly as aggressively or as quickly as the markets are predicting. For what it's worth, I'm tipping the Reserve Bank of Australia will begin lifting rates later in the year and will lift by around 1% in total. Anyway, that's all for me today. Just a quick video to give you the latest on what markets are thinking around Australian interest rates. Be sure to leave a like and subscribe, and I'll see you in the next video. Thanks for watching.